Okay, good morning. We're going to get started today. There is a question in Learning Catalytics. You need to answer it. It'll be open for a couple minutes, not very long. But before we go any further, we have someone here from Accounting Association. Her name is Rachel Moore, and I'm going to let her talk to you.
Good morning, everyone. So I'm the Community Service Officer for Accounting Association, but I'm just doing a quick little presentation on why it's so important to join. So we meet every single Wednesday, so today, 5:15 to 6:30-ish, and it's also in this room. So it's really cool to come. Free pizza every meeting. I think this meeting we're getting Jimmy John's, don't quote me on that. So just to let you know, it's open to all accounting, finance, and CIS majors. Accounting Association is for those of you, like right now, taking financial accounting. You can also join Beta Alpha Psi, which is the actual accounting fraternity, mostly when you get to junior year. It's just really great to meet people, network. We have firms that come in every week. So today, Ernst & Young is coming in. So they're really, they're a Big Four accounting firm, and they're coming in just to meet you guys. So it's really important. So does anyone have any questions? I didn't want to take up too much time. But we do meet today, this room, 5:15 to 6:30. Yeah, so a typical meeting, like I said, we have firms come to each week's meeting. We give them the topics to present on. So like I said, they want to come to meet you guys. They want to come and present on the topic we give them. So EY is coming tonight. They'll pretty much just go over whatever topic it is. I'm not too sure what the topic is tonight. Probably something for Meet the Accountants night that's tomorrow night. And they'll open it up to questions, and then at the end you can network, get business cards. If you keep relationships with these people when you hit junior year, it's a really great in to be able to get a job or an internship. So yeah, it's really important. You do not. You do not have to dress up. It's really great. Don't look like a schlub, but look nice, but you definitely don't have to dress up or anything like that. So it's really great, and free food, like I said. Thank you.
Thank you, Rachel.
Thank you very much.
Okay, so there was Accounting Association. Just a quick reminder, if you are an accounting major, we have Meet the Accountants night tomorrow night. From 5:30 to 8. If you're available during that time, this is a wonderful opportunity. Just a reminder, you have to be dressed appropriately. If you have any questions about what dressed appropriately means, be sure to email me. They will turn people away at the door. And the background on that is these are employers that come in, and if someone slips by in shorts or jeans, we hear about it from the employer saying, your students aren't prepared for this, blah, 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 blah. So we don't let anyone in. So it is driven by the employers. They expect you to look professional. Business casual is fine. Again, if you have any questions about what you can wear, email me and we can talk about that. Okay, so Learning Catalytics. The question is in there, what's due this Saturday? So Saturday, due this Saturday, here you go, it's a Chapter 2 homework, okay? So Chapter 2 homework is due this Saturday. I will also tell you that Learning Catalytics, starting today, is 50% participation, 50% accuracy. If you're just paying, if you come, it should be fine. I've uploaded Monday's scores to Learning Catalytics. I'm having to go through an extra couple steps for the next couple weeks, so it's taking longer than it will ultimately, but you should be online and you should see. If you see class on whatever date and you don't have a score, then your score didn't get uploaded for whatever reason, so you would need to email me. Anyways, I did have some people on Monday who must have paid for Learning Catalytics, but my accounting lab is expired. I can't upload your score if you haven't expired my accounting lab account, so that's why you don't. So you do want to look. So that's the problem with just renewing Learning Catalytics. I assume by this weekend, when everyone renews My Accounting Lab, everything will be fixed then, but that's why. So if you look in, if you go into My Accounting Lab, click on results, you do want to see that your scores are getting through. And we do have, it is 50% participation, 50% accuracy starting today. Okay. Okay, that question will be open another minute or two, but I'm not going to make any announcement about when I close it. It'll just be there. So if you're joining us, we're 5 minutes into class. It will close fairly soon, but I'm not going to announce it. So those of you who have answered it, it hasn't closed yet. Okay, so we're going to do a bunch of homework problems today. The reason we're doing homework problems is I want to illustrate what the concepts are. So I want to illustrate using homework problems. So we're going to be working through transaction analysis today. We're going to talk about increasing and decreasing counts, and then we're going to quickly get into debits and credits and those rules. So it's going to be an action-packed day. It's going to go along at a pretty quick clip. It might be the sort of day that you want to go back and review as we go when you're doing your homework. If you can't do the problem, go back and review the recording. Okay, so we have the first exercise. Kathy's catering began with cash of $15,000. Kathy then bought supplies for $4,400 on account, and separately Kathy paid $7,500 for equipment. So we've got questions to answer. Okay, so the first question we're answering is how much in total assets does Kathy have, and the second one is how much in liabilities does Kathy have. Okay, so we're given some transactions. The first one that we start with, it says Kathy's catering began with cash of $15,000. Okay, so cash is an asset. When we begin with cash of $15,000, that isn't a transaction, but that is a balance. They're asking for Kathy's total assets and Kathy's total liabilities. So beginning cash, that's an asset. Okay, so we're not doing debits or credits in this problem. We're just saying, let's look at the impact on assets of everything we're given and the impact on liabilities. So then it says, Kathy then bought supplies for $4,400 on account. Every transaction has two sides, okay? So this is a transaction, bought supplies for $4,400 on account. Assets went up in that equation, in that transaction. Assets went up because she bought supplies. She gets supplies. Supplies is an asset. So supplies went up. When the words on account there, whenever you see on account, automatically that's accounts receivable or accounts payable. Accounts receivable deals with our customers. Accounts payable is our suppliers or our vendors. In this case, she's buying supplies from her vendor, so this is accounts payable. Accounts payable is a liability. So this transaction, bought supplies on account, increases assets and increases liabilities. So this is an example of a transaction that will increase assets and increase liabilities. So keep that in mind. The next transaction, Kathy paid $7,500 for equipment. Now when it says paid, unless you see the words on account or some other similar wording, but if you see paid, that means she paid cash. Okay, so in this transaction, paid $7,500 for equipment. Cash is going down, and equipment is going up, right? Because we're paying cash and we're getting equipment. So we're reducing one asset and increasing another. Okay, so here's what's going on in this problem. We have a beginning balance of cash, which is an asset. Then we have the first transaction where we increased assets and we increased liabilities. In the second transaction, we decreased assets and increased assets at the same time, because every transaction has two parts, and we'll see more and more of that today. So given those, we can now answer the questions. How much in total assets does Kathy have? Well, we go back through those transactions and we pick out all the assets, all the things that had impact on assets. So going back to this, we had an asset beginning balance of $15,000. We had supplies go up by $4,400. We had assets go down for cash and assets go up for the computer, for equipment. So what we see then is that $15,000 cash plus the supplies we bought for $4,400, plus the $7,500 we paid for equipment, minus the $7,500 of cash that we spent on the equipment. So total assets for Kathy would be $19,400. That's all we're doing there. We're not doing debits or credits. We're just looking at the impact on assets and liabilities of every transaction. That's assets. So next up, we answer the question about how much in liabilities does Kathy owe. Well, in liabilities, if we go back to where we had the transactions marked, okay, the only liability there is $4,400. There were no other liabilities mentioned in that problem. So if we go back to how much in liabilities does Kathy owe, it's going to be the $4,400. That was the only liability listed in those transactions. Okay, so that's it for that exercise. It's just asking you for the impact on assets and impact on liabilities, so you can go through. The most common question I get on this problem is, why are you, back to the asset piece here, the most common question I get is, why are you subtracting $7,500? Well, when we buy equipment for cash, we're getting equipment in, so we're increasing an asset, but we're paying cash, so an asset is also decreasing at the same time. So that's why it's added and subtracted in there. Okay. Any questions on that? Yes. If you had purchased the last, if on the liability transaction, if you had purchased equipment on account, you would again have assets going up and you have liabilities going up then, yes. So it's because we paid cash that assets are going down. Okay. So we have a question. I just sent the question out. Okay. So which of the following transactions will increase one asset and decrease another asset? So take a look at this. Put up the chat room, please. Put up right there. Can you pick it up there? Okay. Mm-hmm. Chat room, session ID. Okay, on this one, so let's kind of walk through what we see here. Okay, so we have about 90% of you correct, so I want to get a lot more of you correct than there. Okay, so which of the following transactions will increase one asset and decrease another asset? So we're looking for a transaction that has two assets. So let's just look at each letter. So letter A, the purchase of office supplies on account. So office supplies, that's an asset, right? So there's one, but then what's the other part? On account. On account automatically means accounts receivable or accounts payable. Which one is it? Accounts receivable means our customers, accounts payable means vendors. And if we're purchasing office supplies on account, that means accounts payable. Payable to liability. So it cannot be A. It cannot be A because A is an asset, supplies, and a liability, accounts payable. So not A. So B, the performance of services on account. The performance of services on account. If I perform services, that's service revenue. Service revenue is a revenue account which impacts equity. Right there, that one fails. I don't have to go any further because we're looking for something that has two assets. So C, the purchase of equipment for cash. Equipment is an asset. and cash is an asset. Okay? So what we're doing when we're purchasing equipment is we're going to increase equipment and decrease cash. So hold that thought. D, the performance of services for cash. We perform service. We have service revenue, which is an equity account, so it can't be D. So what you're looking at here is going to be C, and you have about 10 seconds to get your answer in, and I'm closing that. Okay, so now on to the next one. Okay, so now we're looking at transactions, and here's where we get in the heavy lifting for today. We're going to be doing just what we're doing about what two things are involved. Every transaction, at least two accounts are involved. There's two sides to everything. We have a double entry accounting system, which means we're getting something and giving something up loosely defined, and we affect at least two accounts, if not more. Okay, we have a T account. Now a T account, it looks like a T, and across the top is the name of an account. It is a device just for keeping track of what's going on in an account. By an account, I mean something like cash, something like accounts payable, something that we're trying to keep track of to know the balance of at the end. And a T account, important to know, debits are on the left, credits are on the right, always. That's something you have to memorize. Debits on the left, credits on the right. Okay, so it doesn't matter what type of account it is, you will always see debits on the left, credits on the right. We're going to see an example of a T account coming up and how you would use it. Okay, so double entry accounting, two sides to everything. Okay, and again, the T account, it looks like a T, it has an account name, account title on it, debits on the left, credits on the right, and it's a way that we can calculate a balance. A T account is not part of the financial statements. It's a way to calculate quickly how much cash we have, or what's the balance of equipment, or what's the balance of accounts payable. So you know that everything on the left gets added up, everything on the right gets added up. You take the difference between the two, and when you put a balance in, it goes on the side that's greater. So the two sides get added up, take the difference between the two, and put it on the greater side. And we'll see that coming up here in a homework problem that we're going to do. Okay, so we're going to do short exercise 2-3. We probably have 6 homework exercises today, but many of them, like this one, are short. Okay, so this one we're going to do a T account. We have a series of transactions. Someone opened a medical practice, and we have a series of transactions. Now, we have to look and see what's being asked. And what's being asked after these transactions, how much cash does the business have to work with? So use a T account to show your answer. So this exercise is not asking us to analyze every transaction. It is saying how much cash do we have. So we're going to look through every transaction and look for the impact on cash. We are not doing double entries or journal entries for this exercise. All we're doing is we're saying what's happening to cash, and we're going to use a T account at the end to get our balance of cash. So that's why we're doing this one. So first one, July 1st. Patel invested $60,000 to start her medical practice. The business issued common stock to Patel. Okay, so we are looking for cash. Is there any cash in that transaction? Sure, she invested $60,000. Remember, we are doing this from the side of the corporation. We are looking at the corporation. So the impact on cash for the corporation is cash increased $60,000. So we'll just make a note of that somewhere. We have cash going up by $60,000. Okay, so that's one. So now we're going to go to the next transaction. And we're going to do, okay, so July 1st, cash went up by $60,000. The next July 1st, purchase, oops, I went backwards here. Purchase medical supplies on account. We purchased medical supplies on account. We're getting medical supplies. We're giving an IOU on account. In this case, since we're purchasing, it's a vendor, it's accounts payable, it's a liability. There's no cash involved, so we don't have any impact on cash from the purchasing medical supplies on account. Next one down, July 2nd, paid monthly office rent of $4,700. You see the word paid, unless you see something like on account or some other words to tell you not otherwise, paid means cash is involved. So on this one, cash, we paid monthly office rent of $4,700. That is going to be a reduction of cash. I put a little minus sign in front of it. Cash is going down by $4,700. So when we issued stock for cash, cash went up. So we had that plus 60. Now we have a minus 4,700. So we're just looking for, did cash go up or down? Okay, and then the third, July 3rd, recorded $10,300 revenue for service rendered to patients. Received cash of $4,200. So this is a medical practice. Patients don't pay fully for everything. So you get some cash every day, and then a bunch of it is on accounts receivable, because these are customers. So in this case, the impact on cash is cash went up by $4,200 for July 3rd. So we have three impacts on cash from this problem. We have the $60,000 we received to start the business. We have the $4,700 that was spent for supplies on July 2nd, and then we have cash of $4,200. July 2nd, cash was spent for rent, and then July 3rd, we had cash of $4,200. So now when it says, what is our cash balance? The problem is asking how much cash does the business have to work with, use a T account. So I'm going to take those numbers and I'm going to put them in a T account. So what you're going to see down here is somehow I have a straight extra line. Okay, so I'm going to tell you which line you don't need, and I don't know how this got in here. This line right here you would not need. Okay, so $60,000 on the debit side. On this you're going to trust me, because in just a minute we're going to talk about debits and credits. Cash is an asset, so you're going to have all your increases on the left side. So I put my $60,000 increase on the left side, and I'm going to put my $4,200 increase on the left side, and then my decrease on the right side. T accounts never have positives and negatives. Okay? All the increases to an account, to an asset, go on the left. All the decreases go on the right. So then you draw a line under them, and you're going to add the $60,000 plus the $4,200, and then you're going to subtract the other side, the $4,700. So I'm taking $60,000 plus $4,200 minus $4,700, and I get $59,500. I put it on the left side because the left side is larger. You will never have a positive or negative number. You always put that number on the side that's larger. Okay, so that's a basic introduction to a T account. We just have a extra line in there for whatever reason. And the line at the bottom tells you the total goes below that. So all the things above that bottom line are all the activity that went on during the period. The line says, okay, we're going to put a total in. You take the one side, subtract the other side, and put it on the side that's larger. Okay, now we have a handout. And so this will be an activity you guys are going to pass out. We also are handing this out online. It is also available on Blackboard. So if you don't, and Amir is going to send you out the link online. And if you have, when the extras, if you're in the very back row, put it on the end of the back row and I'll pick it up later. Okay, so if you're online and you're not physically here to get the handout, no worries. It is at this URL. Now, you can use this or not. And again, it's on Blackboard. When you take the exam, by the way, when you take your exam, I will be providing you 1 page of notes. So I'll put formulas on it. It's already available. It's on Blackboard. But this is one side of it, or one part of the notes you can use on the exam. So if it's on this sheet, you don't have to memorize it. You will have it for the exam. This sheet contains some really important information. It's also information that when I put questions up here, I assume you have it in front of you. Okay? So if I ask you any questions, so right there under step 3, this is the steps we're going to kind of go through when we do journal entries, when we figure out if something's debited or credited. So we're going to go through the steps, but I want to show you what's in this handout that's so critical when you're answering questions. So again, if you have extras, put them on the end up there. Just leave them up there, please. And so where we have choices, I'm giving you there the types of accounts. That's not a complete list of all the different assets. It's not a complete list of all the liabilities, but look at this. I've given you some very common names of types of accounts. You will have this on the exam. You also need to have it in class here, or if you're online, because sometimes I put questions up. Those questions can come directly from this. If I ask you what type of account is unearned revenue, no one should get this wrong. Unearned revenue, even though it sounds like it should be a revenue account or equity account, unearned revenue is a liability. Okay, it's listed there. So I've listed not all the assets, liabilities, and equity accounts, but I've listed a bunch of them, some common ones. And then also the step 4, I tell you debits and credits, depending on what kind of account it is, what you do to increase it and decrease it. So that table below, assets, to increase an asset. So if we were going to increase cash, if someone gave us cash, to increase cash, we're going to debit it. If we're spending cash, we're going to credit it. And those accounts are listed below. You also may want to edit your sheet where it says type of account, the how to increase column, that's known as the account's normal balance. Whatever increases an account is the normal balance. So if you were to look at a liability account, like accounts payable, it normally has a credit balance. We have double entry accounting, that's assets equal liabilities plus equity. Assets have a normal debit balance. Liabilities and equity, on the other side, have normal credit balances. So that's kind of where this whole system comes in. Now we'll have debits and credits going. It takes a lot of practice. If you've never seen this before, it's like a foreign language. It will take practice. And I don't know that that practice is going to occur in the next few weeks. But know that you don't have to memorize this. You have to be able to take this and be able to tell whether you debit or credit something based on the transaction you're given. You have this. I'm not saying you have to memorize it. Yes? Okay, on T accounts or any accounts, the debits are always on the left, credits are always on the right, regardless of what kind of account it is. So like accounts payable, if you're increasing accounts payable, the credit goes on the right. Okay. So this is my spiel, that this may seem foreign and seem awkward, and it very well could be. But you have this handout. You have this available on the exam. You have this available whenever we do questions in class. So you don't have to memorize this stuff. We're going to be using it. Typically, when you approach a transaction, you say, pick one account that's impacted by this transaction, and then if that account, usually I pick cash. And then I say, is cash increasing or decreasing? And so I can tell if it's increasing or decreasing, what type of account it is, and then go down and pick, based on that type of account, do I debit or credit it? And then you go back and do the other one. Debits have to equal your credits. We'll see this. So we're just going to jump in and we're going to do it, but know that the sheet that I've given you, you've got this exact sheet on the exam. You've got some other information as well. So this is not information you need to memorize. You're going to have to look things up. When we look at a journal entry, we'll use the sheet. If we do questions in class, use the sheet. It has what you need in many, many cases. Okay, so debit credit rules. So down here at the bottom, see that little table? You may want to put little asterisks around it where I said increase assets, liability, equity, revenues, expenses. Okay, how to increase them, how to decrease it. That's what's going on here. This slide, if I were going to do a screenshot, this is another good one, but it's reiterating what you're seeing on down here on that table, how to increase assets, liabilities, equity, revenues, expenses, dividends. That's what it's doing. So we know that debits will increase assets, expenses, and dividends. Okay. Debits decrease the other side of the equation. So these are just rules we're going to use. It's one of those things you're just going to have to trust me on this. These are the rules we use. The debits will equal the credits, and everything works out in the end. So we're going to get into some practice. So we have a journal entry. So let's talk about journal entries. Journal entries are how we record transactions. Transactions happen. We go out, in this case, we bought a new machine for $8,000 cash. So how does that impact what we're doing on our books, on our financial statements? So when we buy a new machine for cash, we're going to record it using a journal entry. The journal entries are recorded electronically, but they look like this. What we will do is we have a journal, and the journal is a running list of all our transactions. So we have this journal. We're going to record transactions in it. The journal is typically, we think of it as columnar, and we have a column for the date, we have a column for the accounts, and then we have a column for the debits and a column for the credits. Every transaction will have equal debits and credits. So the debits from a transaction will equal the credits. Our accounting equation will ultimately always be in balance. We have assets equal liabilities plus equity, assets increase with debits, liabilities and equity increase with credits. So it all is based on this accounting equation. So we're going to do our journal entry. Now, we buy a new machine. First thing I know is we buy a machine, so that's equipment. Equipment is an asset. So I'm going to write the date. The date is important because it tells me later what day I did this on. When we record every transaction, there has to be documents supporting it somewhere. Our auditors are going to come in and verify that we're just not making things up. So everything's cross-referenced. So this is cross-referenced to a date. There's most likely an invoice number or a PO number associated with it as well, but we're not going to do that much detail in here. So we always have the date, and then we're going to put the account. Debits are always first. These are some unbreakable rules. This is the way it's done. Debits are always first. Always, always, always. Can't avoid it. So we're going to, our asset, this is an asset. We're getting equipment. So that's the asset we're picking. Equipment is increasing. To increase an asset, we debit it. So what I just did is I walked through 3 steps on the handout. And so my 3 steps on the handout, I picked an account, equipment. Is it increasing or decreasing? Well, it's increasing. What kind of account is it? Equipment is an asset. And then to increase an asset, step 4, I would debit it. So that's where I got to where I am now. Okay, debits go in the left column, the column titled debits. We don't typically use dollar signs, although in my accounting lab I don't think it cares if you use dollar signs, but you just put it in there. So that's one part of the transaction. We are not done yet. Our debits have to equal our credits. Now, right now, I know I need a credit for $8,000. So I could put $8,000 on the next line down in the credit column because I know that. And I'm 75% done with this journal entry. I don't have to figure out if I debit or credit the next thing because I know it has to credit. My debits have to equal my credits for every transaction. So the other side of this, if I think about what's going on here, I bought equipment, so I got equipment. What did I give up? I gave up cash. So I've got cash as my other account. Cash is decreasing. to decrease cash, I will credit it. So the other side of my entry is going to be cash. Now, something important to remember. Cash right there is indented. That means it's a credit. On your homework and tests and whatever, you have to indent credits. If something is in the far left column, like equipment, that is a debit, okay? So you've got to indent credits. So debits go first. Debits are all the way over at the left margin. Credits follow debits. So you could have 2 or 3 debits. They're all going to be listed first, and then your credits are indented and they go in the credit column. So what I've got here is I've got my 2 accounts. I've got equipment increasing with an asset. It's an asset, so it's going to be debited. I've got cash decreasing. It's an asset, so I'm going to credit it. My debits equal my credits. I have 1 piece left. I also need some kind of explanation for the journal entry. It's no big deal. It's a memo line, an explanation line. So I'm going to put down at the bottom, purchased a machine or something, because we just need to be in the habit that we record what it is. In real life, they're putting an explanation of what this is. Here's all the documentation. They'll put information so that this can be cross-referenced to where it happens, because we need to be able to verify it later. But what you have here is a journal entry, okay? So every transaction gets a journal entry. Cash is being credited here because it's being decreased, okay? Now, this is important. I'm glad you asked that question. Now, on the sheet that I handed out, notice that there's that table at the bottom that says to increase cash, you debit it, to decrease it, you credit it. Now, immediately, people will think, but when I get my bank statement, if they debit my account, they decrease cash, and if they credit my account, I get an increase. And that is absolutely backwards from what I'm telling you. They're right, and I'm right, and let me tell you why. Your bank, okay, let's think about the bank here. When you deposit money at the bank, it's an asset for you. What kind of account is it for the bank? When you if you have $100 in your checking account, what kind of account is that for the bank? Asset, liability, or equity? Liability, right? The bank has a liability because they owe you $100. So if they charge you a bank service fee, they're reducing your account, right? So to reduce a liability, what do you do to it? On your rules, the liability, to reduce a liability, you debit it, right? So they'll tell you, we debited your account for the service fee, the ATM charges or whatever. They debit your account and your account balance goes down. That's because it's a liability. If you make a deposit, they'll say, we credited your account. They credited your account because this is their liability. So your bank statement, when your bank writes to you and says we debited and credited things, they're talking about their own liability, okay? So you have to really rely and train yourself to look at these rules, because that's the easiest thing to do is think about cash in terms of your bank, but your bank is talking about a liability, not an asset. Okay. So now we have another question. Okay, on this question, right now 25% of the people who have answered, we're up to 73% have answered right. On this question, you can get the right answer. It's on the sheet that I handed out or that you would download. Okay, so look at the box, look at that table. Okay, so when you're doing this question, right now, only 85% of you have it right. So the handout that I've got, that you've got in front of you, there is a box in step 4? Yes, step 4. There is a table, and that table, it tells you what increases and decreases each. So you would go and, like, for example, look at A, an asset is increased by a debit. So look in the table, look for asset, and then see what it's increased by. And if that agrees with it, you would select that. Look at the next one. Dividends are decreased by debit. So if you get an answer along the way, you probably don't need to go any further. I'm going to close this question in about 10 seconds. Again, this answer is directly in step 4 on the handout. Okay, so an asset is increased by a debit. Those kinds of questions should be really easy targets for you. You should be excited if you see questions like that because they should be easy. Remember, when you take your exam, you'll have the information on the sheet, on your exam sheet that I provide to you, so they should be gimme questions, okay? So get used to referring to that table. You don't, if you work with this enough and practice it enough, you will memorize it. If you're an accounting major, I would recommend that you do memorize it, but I'm not going to make you memorize it. But if you're an accounting major, this is something good to memorize because you're going to need it and you're going to use it. But the more you use it, the more it makes sense and the more familiar it becomes. But you don't have to memorize it. You'll be given. Every exam in this class, you will have this information on the exam reference sheet. Okay. Okay, so now we're going to do another exercise. This exercise, we're going to be journalizing transactions. So we've got a series of 5 transactions, and we're going to write a journal entry for every transaction. So we're just going to dig right in, and the first one. The first one says that we borrowed $64,000 from the bank, signing a note payable. Okay, so what's going on in here? I like to think to myself, what's happening here? Well, what's happening is we borrowed $64,000. So we have cash increasing, and we signed a note payable. Note payable is a liability. Again, so I'm going to do my journal entry, just talking through this. I'm thinking, what's one account I have here? It's cash, right? I'm getting cash. So cash, is it increasing or decreasing? It's increasing. To increase an asset, I debit it. So I'm going to debit cash. And then on the other side, what else do I have going on? I signed a note payable. Note payable is a liability. I know I'm going to credit it because my debits have to equal my credits. But if I followed the chain of steps, I would say a liability, I'm increasing a liability, and to increase a liability, I credit it. So what my journal entry is going to look like is this. I'm going to, on the first line, have the date, cash, and I'm debiting cash because I'm increasing an asset. Again, I'm referring to my step 4, what increases or decreases an account. Cash is an asset. Cash is a really good one to know because if you can memorize just cash, that'll get you through about half the journal entries. So I'm going to debit cash. And I do my debits first. It does matter. Debits have to be first, and they're on the far left. Now, the next one, I have a liability. I know it's got to be a credit because my debits have to equal my credits. So my credit is going to be to note payable. Okay? Remember that I indent that credit. And then I've got the explanation. You have to put some kind of explanation, and this is borrowed money from the bank. So that's what I'm doing for this journal entry. So we've done another journal entry. That's the journal entry. When you do your homework, this should be pretty straightforward. This is easy, right? Because you're going to do the same journal entry. It's going to give you different numbers, but you're basically going to be increasing cash with a debit, increasing notes payable, a liability with a credit, and have an explanation. Okay, so next up, perform service for clients on account totaling $17,100. Okay, perform service. When we see the words on account, right off the bat, I see the words on account. I know accounts receivable or accounts payable. I know that accounts receivable or accounts payable is involved. Okay? Now, which one's which? Accounts receivable is our customers. Accounts payable is our vendors. When we look at this, We perform service for clients, so that has to be accounts receivable. So we'll just start there. So for this transaction, I have accounts receivable. Accounts receivable is an asset. It's increasing because these clients now owe me. So I'm going to debit accounts receivable. And then the other part of this, what else happened here? We performed service. Performed service, that's service revenue. So what we're going to see here is we've got service revenue. I did these backwards. Okay. So October 22nd, my debit is accounts receivable. And $17,100, notice the debit's in the far left, it's in the left column. And then the service revenue, where I perform service, it's an equity account. Revenues are increased with credits, referring again to our table. And then the last line is a memo line, just saying what happened here. Okay, now, so we've done 2 journal entries. By the way, every time you perform service for revenue for clients on account, it will always debit accounts receivable, credit service revenue. So after a while, some journal entries will become familiar and they'll always just look the same, just the numbers change. Okay, next one down. We received $10,300 cash on account from clients. So we received cash. So again, asking myself, cash involved? Cash is involved. Cash is an asset. It's increasing here because we're receiving cash, so I'm going to debit cash. So in my journal entry, I'm going to debit cash for $10,300. The other side, when we see on account, that's either accounts receivable, which involves our customers, accounts payable, which involves our vendors. In this case, we receive cash on account from our clients, so that's accounts receivable. So my second entry here, I'm going to credit accounts receivable. Accounts receivable is an asset. When customers pay me back, that asset decreases. And to decrease it, it's got to be a credit. And then I'll have a memo line for what happened in this case. So we figure out one side, in this case, cash you could always, usually cash you can figure out if it's increasing or decreasing. Figure out which side it goes on, then you know the other side, you know it's a debit or credit. In this case, we knew we were crediting something, and what's going on when you see the words on account, it's either accounts payable or accounts receivable. Accounts receivable is our customers or clients. That's what was going on, so boom, we're done. So usually if you can anchor yourself with what's going on with cash, that makes that one pretty easy. Okay, next up. Received a utility bill of $1,450, an amount that will be paid during November. Okay, this one has no cash involved, but we do have a utility bill. We do owe it. We're just not going to pay it till later. So for this one, we're going to, we have utilities expense. We have used utilities. So we have utilities expense, electricity, gas, or whatever this is. We've used utilities. So I'm going to have utilities expense. I know it's debited because I refer to step 4, that expenses, to increase in expense, we debit it. Okay. Now, the other side of this, so we have utilities. We're going to pay this in November. If we're going to pay something, we owe it now. That's a liability. So we're going to credit accounts payable, and then we'll follow up with that memo line. Now, the 5th entry, and in these entries, I will tell you, the more you practice them, the more they become familiar. They start looking familiar. So the 5th one, we paid monthly salaries of $10,100 to employees. When we look at this, is cash involved? I love entries that involve cash. We paid salaries. So what's going to happen here? We paid, that's cash going out. Cash going out has to be a credit. So we know we're going to credit cash. So we'll skip to the second line, do our credit. Then the debit, we know we need a debit, and what is this? Then you say, well, okay, it's salaries expense. So I'm going to do my cash first, and then I can plug in, I know I need a debit. What is this? Pick something in that you'll get close. In this case, monthly salaries. What are you doing? Salaries. Salaries expense. That makes sense. And again, some of this is just becoming familiar with it as we go. And paid salary expense. Okay, so we have finished that homework problem, and now we're going to do a quick question, and then we're going to move on to, we have 2 more learning objectives in the chapter, so we're not done yet. Okay, so next question up. Okay, first thing, the company received cash. So receiving cash is increasing an asset. So that's what it's telling you. So cash is increasing an asset. So if a company issues stock in exchange for cash, it would receive cash and it would be issuing common stock. So when you're looking at your sheet, I'm going to borrow your sheet because I don't have one, if you don't mind. Okay. And when you're looking at your sheet, when we look at common stock, we see that in step 3, okay, common stock is the other account involved here. So step 3 on your sheet, what kind of account is common stock? Okay, so locate common stock in step 3, and then so you see that common stock is an equity account, right? So we issue stock. We're increasing stock, right? We're issuing common stock that wasn't issued before. So we will be increasing an equity account. So in step 4, what do you do to increase an equity account? Okay, so again, looking at your sheet, right now, 86% of you are correct, okay? So looking at your sheet, I'm telling you right now, cash is the asset. The other side of this is common stock. We issued common stock. Common stock is an equity account. It increased, okay? I'm going to close it in 10 seconds. Again, common stock is the other side. It increased common stock. You can look at step 3. Common stock is an equity account. Get your answer in. Okay. So it is increasing equity. Okay. So again, example of how you can use that sheet to get you through answering several different types of questions. Okay, so now we're going to, the journal is a record of all our transactions. Do that. Okay, here's what I want to do. So we write a journal. What happens next? So we write the journal. If you have the PowerPoint notes, there's several good slides, but we're going down to the posting one right now. So we write a journal entry. So that's what's in the middle of the page. This is Exhibit 2.9 in your book as well. So you've got the journal entry you've written. What you do next, what companies do after they write all these journal entries, is they post all the journal entries to the accounts in their general ledger. So for example, this cash right here on April 1st, that debit, it's going to go to the cash account. We use T accounts to represent the accounts. So in real life, 40 or 50 years ago, accounts were represented by cards. So you would have a card, a big card for cash, and they would post all the cash to it. And then you would have a big card for accounts receivable, etc. So you would post to the card, the account, now it's electronic, but the account gets a debit because you debited cash in the journal entry. Then common stock is going to get a credit because you credited in the journal entry. So all you're doing when you post the accounts is taking the things in the transaction and putting them in the accounts. Debits go on the left, credits go on the right. Doesn't matter what type of account it is, that rule holds true for every single account. So if you debited in the journal entry, it goes on the debit side of that account. If you credited it in the journal entry, it goes on the credit side of that account. Okay, so what happens from an accounting standpoint is the transaction occurs, we analyze the transaction, figure out what happened, we write the journal entry, goes in the journal, and then the amounts are posted to the ledger accounts. This is an example in the notes that you can look at. I'm not going to go through it specifically right now. Good. Okay, but we are going to do this question. Again, I'm going to walk you through this one. Okay, when a business purchases land on account, okay, so let's ignore the answer questions, the answer choices right now, and let's walk through what happens when a business purchases land on account. So let's just pick an account. Let's pick land. Okay, so we're going to make a little journal entry off to the left, and then we're going to see what answer fits that. So a business purchases land on account. So it's looking at land. So going through my steps, land is step 1. Step 2, is land increasing or decreasing? Land is increasing, right? So land is increasing. Step 3, what kind of account is this? It's an asset. It's not listed there, but it fits with inventory. It fits with prepaid insurance equipment. So land is an asset. To increase an asset, then we're going to debit land. Okay, so we are debiting land and assets. So you have a note of that somewhere. So then let's repeat for the other side of this transaction. On account. On account means automatically accounts receivable if it's our customers, if it involves our customers. This one does not. So on account has to mean our vendors or our suppliers. So this is, we bought land from someone, so we bought it on account. So that's going to be accounts payable. So accounts payable is my answer to step 1. Step 2, is it increasing or decreasing? It's increasing because now I owe money that I didn't owe before because I bought this land. So we're increasing a liability, and it's a liability. Step 3 is a liability because accounts payable is a liability. It's listed there. So what we've got now, as an overview, we are debiting land and asset, so it's increasing. We are crediting accounts payable, a liability that's also increasing. So now, with those answers, so we know right away, when I'm looking at this question, I have an asset, land, right, and I have a liability, accounts payable. So I know I can eliminate B, right? So it can't be B. So we're already increasing our odds. So then we know that land is going, it can't be A either, right? So we've eliminated A and B. So it can't be A or B. So now it's down to C or D. So we know assets are increased. Land goes up. So now accounts payable, our liability. We know our liability increased, right? Our liability went up. So then we can make the choice. So you have about 10 seconds to make your choice there. Get your final answer in. Okay. So both assets and liabilities are increased. We increased our asset, land, we increased accounts payable as well. Okay, next up we have a trial balance. So we go through the period, we write all our journal entries, we post all our transactions to the accounts, and we get final balances of the accounts. And that is called a trial balance. And a trial balance lists all our accounts with their balances. Its basic purpose is to make sure that our debits equal our credits. So when we're looking at this, we want to show that debits equal credits. Okay? There is an order to go on a trial balance. It's assets, liabilities, and equity accounts. Follow the order that I've shown you here. The first asset is always cash. They're from most liquid down to least liquid assets. Same with liabilities. Accounts payables first, followed by other ones. And then equity accounts, you'd see revenues, you'd see the equity accounts, common stock, retained earnings, then you're going to see your revenues, expenses being listed there. So the purpose of a trial balance is to have debits equal credits. A trial balance is usually prepared at the end of the period. A trial balance is not a financial statement. It's not a financial statement. It is used to help prepare the financial statements. But its purpose is to make sure mathematically that we've done everything correctly so far. Okay, back to that handout. I said this earlier. On the handout, the table that's in step 4, okay, the table that's in step 4 will give you, okay, normal balances of the accounts, Exhibit 2-4. You just want to start table 4, the increased column. You can call that increased column the normal account balances. You've got what's up here in the how to increase column. So the normal balance for accounts is listed in that how to increase column in step 4. Okay? Okay, so what we're going to look at now is a trial balance. And a trial balance is a listing of all the accounts. So this is a homework problem. It gives us a list of accounts in random order, and we're told to prepare a trial balance. So what I'm going to do right now is I'm giving you the trial balance. So I'm going to wait a minute. You can kind of jot it down, and then we're going to talk about it. So I'm going to go quiet for about a minute till I see the pencils up, and then I'll talk about this. So I've just done the trial balance, then I'm going to talk about why it's this way. Okay, I see a lot of people done or just finishing up, so we'll get started. First, in your notes, trial balance next to trial balance, right? Not a financial statement. This is not one of the major financial statements. So don't mistake it. The financial statements are income statement, balance sheet, statement of cash flows, and statement of retained earnings or stockholders' equity. This is not a financial statement. This is used to prepare financial statements. So we're just doing, when you prepare one, typically the name of the company, the trial balance, and then the date line. A trial balance is as of one date. So that's important. When you prepare it in homework, you'll be asked, you have to choose between year ended or whatever. A trial balance is a balance as of a date. So December 31st. We have accounts listed in the left, and then we have a debit column, a credit column. This one's in millions. So again, don't put those extra zeros in if you're not asked to. And I'm going to list my accounts. The order has to be like this. Assets are first, assets are first, liabilities are next, equity accounts. So cash is first, always first, and then you have your assets in decreasing order of liquidity, accounts payables, always the first liability, stockholders' equity. This is the order they go in, okay? This is our order, and you can kind of replicate that order in the handout. So again, the box in step 4, it gives you the order a trial balance goes in. So again, this isn't something you have to memorize. You'll be given this handout. This is part of the note sheets you have on your exam. So You're going to list the balances of all the accounts, and the normal balance is the side it goes on. And again, what's the normal balance of an account? It's the column in step 4 box, how to increase. Assets, cash has a normal debit balance, other assets have debit balance. So assets have normal debit balances, so they'll go in the debit column. Liabilities have normal credit balances, so they go in the credit column. Stockholders' equity, normal credit. Revenue, normal credit. And expenses have a normal debit balance. So when I'm done listing my accounts, I draw a single underline. I total that column. So I've got my debits of equal 52 million, my credits equal 52 million, and I am balanced. I have done everything correctly. So that is what a trial balance is. Now this question also asks, what's their net income? Net income is revenues minus expenses. So revenues minus expenses, where so 38 is my revenue, 27 are my expenses. I take the difference between the two, and that is my net income. Okay, so that's a trial balance. Now, we have another question, not this one. Okay, so you have a question. A trial balance is one of a company's major financial statements. True or false? Okay, we just did a trial balance. I told you to write it in the margin next to the trial balance. Is a trial balance a major financial statement? Okay, as we finish up, I want to conclude by saying that Chapter 2 homework is due this weekend. It's due Saturday. I will be posting via an announcement probably tomorrow a couple step-by-step videos on a couple of the homework problems we didn't do. You can watch them if you want or not. But if you want help with some of the other homework problems, I'm going to be posting little videos on those, and I'll send those out via announcements and the email. So on this one, a trial balance is one of a company's major financial statements. True or false? Let me ask you just at random. I'm going to put you on the spot. True or false? False. You say false. Do most of you agree? I would agree with that too. Okay. You see a scramble here for answers changing. Okay. Okay, and that is false. It is not a financial statement. Okay, so that's it. Have a nice weekend. Have a nice rest of the week, and I will see you on Monday.